Looking at what the interest rate traders are pricing in, they say 36%. Are they delusional? Did they hear what Jay Powell said yesterday? Because it seemed like he said it's pretty much just not going to happen.
Yeah, no, look, this was what we expected. I think March is off the table, but he did open the door to May. Yeah. Now, we still have June in our forecast, but he took out the tightening bias, talked more about normalization, made it very clear that most of the committee feels that this is something that should play out over the course of the year. But he came back to what we've really been looking at, which is that we still see core CPI at around 3%, and the services piece of inflation still remains about 2 percentage points above where it was before the pandemic. And I think that is really where we have been focused, is that it's too early still to declare victory on inflation.
Okay, too early to declare a victory, but do you believe we're on the path to a soft landing?
I think we're on the path to a soft landing this year, but I still think there are risks when you look towards the end of the year and into 2025. And what we do see is that you're going to see some slowdown in growth. But I think the focus right now isn't so much on the growth story, it's on the inflation story. Some of this disinflation story that we've seen for goods seems like, it's tapering off. And you still have on the services side, we're not where we need to be. And look, the geopolitical risks do matter.
I think they do. I was going to ask you about that. So even Jay Powell admitted there's some risk to the economy from moving too soon or too late. And as you mentioned, there's a lot of geopolitical risk. There's a war in Ukraine. There's a war in the Middle East. Oil prices haven't really moved a lot, but they certainly could. How does the Fed view all that different risk? And now we may even have some regional bank risk. We're talking about New York Community Bank earlier. How does the Fed view all that risk? Why not just cut? Because it seemed like we were really on that path to that soft landing. Why would they even take a risk of making the cut too late?
Well, let's just talk first about the geopolitical risks related to the Red Sea, the Panama Canal. The numbers that our economists have looked at, we think this could add as much as 0.7 of a point to goods inflation. So the whole trend that we saw over the course of the last year, goods inflation coming down, that could be coming to an end. And you have that there isn't a resolution that's coming up with the war right now. So that does have an effect. Now, on the commodity side, we're still looking at oil going towards into the 80s. I think that's much more driven by the supply and the demand factors, not so much by the geopolitical risk. But what we've seen is that the market right now still is putting in some geopolitical risk premium there.
All right. I want to talk to you about the bond market as well. We had Jeff Gundlach on our air yesterday. He says higher for longer is good for shorter term bonds. He flagged the 2-year and the 5-year. Jay Powell also said the FOMC, they're going to discuss quantitative tightening in their March meeting. Does that change your outlook for the bond market?
Well, look, on quantitative tightening, we do think they're going to give guidance at the next meeting, and they've kind of signaled that, where just the runoff, we think will be cut in half from 60 billion to 30 billion, and we still like the 5 years, and we like we still like steepeners, the 530s. We do think there's some scope for yields to come down, and that will play out over a period of time. But I do think that higher for longer, over the medium term is here to stay. And that really comes back to the fiscal debt and many of the other secular drivers we see for real yields going forward.
Okay, this is a big week on Wall Street. It's earnings season, obviously. We have some mega cap names reporting today. And then tomorrow we have the jobs report. And then we have more inflation reports coming after that. How do you and your team, how do you view all these reports? Which ones are the big ones? Which ones are ones that are just like, you don't have to worry about it? Because we seem to kind of look at every one of them as a possible market mover, but in your mind, which ones do we really need to look at?
Well, last week I was in Asia, kind of did this whirlwind tour. I was in Tokyo, Singapore, Hong Kong, and Taipei as well. And what you still see is that the earnings revisions outside of the U.S. are coming down more than some of what we are seeing in the U.S. But I think what we've seen is that even where earnings have come in relatively strong, the market hasn't rallied that much. So I do think that there's probably reason to think that some of the momentum that we saw, and also with the Fed basically signaling that it's not March, because that's the message we clearly took away, that you've got to be more selective here. But I do think that the U.S. still continues to benefit because the growth story is looking better.
All right, before we let you go, I'm going to put you on the spot. When do we get the cut? How many cuts this year?
Okay, so we think it's June, but there is a real possibility for May. The door is open for May. We
Crack door.
Yeah, no. So I think it's like 100 to 125 basis points of cuts this year, 25 at a clip. And, May is a real possibility. But I think March, I think the clear message to me was that March is off the table.